Okay, hi everybody who is starting to join. Just make sure I've got everyone coming through here. Stephen, do I need to let everybody in or are they all coming through? Let's have a look.
They're all coming in by the looks of it.
Okay, excellent. Welcome everybody. We're going to kick off in about a minute or so. I'll just let everyone start coming in to the session. We've got quite a lot of people who have registered for this today, so we're going to have some ground rules, so to speak, of how you can ask questions and interact. And then we'll get right into it. So there we go. How are we looking, Stephen? Pretty good?
Yeah, we've got some people just dropping in every couple of seconds or so.
Okay, perfect. Perfect. As you're joining, I just want to get a sense of who we have here in the room with us today. So first question for you is, where are you in the world? And if you can just put into the chat your location, that would be brilliant. Okay, we've got Paul from Singapore. I can see people coming through the chat. Fantastic. Yep, just put in where you're from, just so we get an idea. Paul, there we've got, oh, fantastic. Cape Town, Milton Keynes, not too far away from where I am right now. Okay, awesome. Keep going, keep putting them in there. I know we're going to have a pretty global audience today. Okay, we've got Ashwin from Switzerland. Okay, some people from Wales here coming through. Milton Keynes is popular. There we are. Okay, second question is, I'd like to get a sense of whether you are a founder, so you have your own business, okay? You might have actually just bought the business, so you don't have to necessarily be the founder, but you're a business owner. Or if you're an investor, you invest in businesses doing acquisitions and the like, or whether you're an advisor, and that could be any type of advisor. You could be a legal advisor, a CPA or accountant, or someone who provides business advice. If you can just put that in, that'd be fantastic as well. Great. So we've got quite a few founders. Aspiring founder, fantastic. Love that one, Ashwin. Very good. Okay, excellent. Yeah, I appreciate you can be both a founder and an advisor if you have your own advisory business. Okay, Paul's here, fantastic. As an investor, great. Okay, third question is, what is the one thing that you would like to get out of today? Now, I'm going to be covering quite a lot of work on how businesses are valued, M&A, the process around how private equity works. But it would be great if you've got an outcome or something that you'd like to learn today, and we can reference that as we go through some of the content. Okay, so just put that down. The one thing that you'd like to get out of the time today, and anything that you'd like us to cover. Just to be clear, this is absolutely a workshop and not a pitch. We're not going to be making an offer or anything like that. There's no courses or programs to be bought here today. What we will invite you to do throughout the course of the presentation is, if you want to speak to anyone in our team about what we're covering, then there will be the option to book a call. And a lot of the times when people book that call, it's about understanding what their business is worth today, what it could be worth tomorrow, and just kind of getting a sense of their options. So whether you're a founder and you want to understand that for your business, or whether you are an investor and you're thinking about, how can I evaluate some of the acquisitions that I'm making, then I encourage you to book a call with the team. We'll put a link up in the chat for that. But as I said, that's the only thing that we're offering today. The rest of it is going to be content based around the valuation gap. Okay. And one final sort of point, we are going to have questions at the end. There'll be about 15 minutes for that. That said, if I say anything today that you haven't heard before, that you want more context on, please post the question in the chat. And if we think it's relevant, we'll cover it then and then. Otherwise, we'll make sure that we cover that at the end. Okay, so let's kick off. That's the housekeeping out the way. So what we're covering today, as you know, the title of this workshop is the valuation gap. And I'm going to be covering in quite a lot of detail why businesses leave a hell of a lot of money on the table when they sell. Certainly founders who go to market and don't really understand the importance of getting ready in advance. We're going to cover that. And then I want to go through some of the things that you can practically do to close that gap. And I'm going to go through what that means in terms of the monetary value that we see in our advisory and consulting business of founders who prepare in advance versus those that do not. Okay. In terms of who I am, I'm not sure. I mean, some people know who I am from having spoken at many of Callum's events and things like that in the past. But my name is Nick Bradley. I'm the founder of an advisory firm called High Value Business, highvaluebusiness.com if you want to have a look at the website while I'm talking today. I've personally been involved in over 50 acquisitions, both in sort of corporate and private equity, plus my own investments. I've been involved in a number of exits, 21 eight-figure exits, and I've actually been involved in 3 transactions over $1 billion each. The total enterprise value in my career, which is around about 10 to 12 years in total in private equity, is just over $5 billion. So I say that to really just get across the point. There isn't much that I haven't seen from sitting on the other side of the table. Okay, the person who would be assessing and ultimately buying your business. So that's the lens, if you like, that we're going to be talking through this today. The other thing, just a couple of points. I'm also the author of a book called Exit for Millions, which we'll talk about a little bit through here today, because I referenced some of that content. And I'm also the podcast host of Scale Up with Nick Bradley, which was launched in 2019. We've done over 400 episodes now. It's ranked, has been ranked the #1 business podcast in the UK. And we cover a lot of really important content on a fortnightly basis for that. So I'm going to put a couple of links in today around episodes that I think are particularly useful as we go through the content. Okay, if there aren't any questions, Stephen, I think we'll kick off. So nothing, good, excellent. So next 45 minutes, as I mentioned, frame your questions for the end unless it's for context. We're going to go through 3 things. We're going to go through why good businesses and valuable businesses are not the same thing, okay, and the characteristics around the differences of that. We're going to cover today 5 crucial gaps that buyers, like I used to be, use to be able to negotiate with founders of how they can extract that business for the lowest possible valuation. To be clear on this, and I'm very unapologetic about how I talk about private equity and my involvement, PE is about buying companies for the minimal amount possible, scaling them with certain strategies and techniques that we'll cover today, and then selling them for a lot more. It is unapologetically about money, and it's the buy low, sell high game. Okay, so the more that you understand that in advance of selling your business or advising one of your clients to sell their business, the more advantageous you are going to be in this whole model. Okay, and then the third thing we're going to cover today is how you close those gaps. What are some of the critical decisions that you need to make to be able to do that? Okay, and for everyone who stays until the end, I'm going to have a free giveaway for you. But the other thing we're also going to do is bring this all together at the end so you can kind of see how this makes sense. And as I mentioned, have some practical things to be able to take away. So to kick off, and I mentioned before that our advisory firm is called High Value Business. There's a reason for that, because this is the definition. This is my personal definition of what a high value business is, taken from that decade or so that I was in private equity. So this is how we would talk about it at the PE board table. Okay, so a high value business is one that makes good money today, predictably makes good money tomorrow, and doesn't depend on any individual or entity to make that happen. Okay, now I'm going to break this down because this is quite a key thing to understand. It looks quite simple, but there are some nuances to the definition. I think we all understand the concept of making good money today. But when I say make good money today, I'm not just talking about revenue. I'm talking about cash flow. Okay, so does your business make good cash or produce good cash today? Is it profitable? Does it have margins that are deemed, the right level, the right range within your industry? Now, if you don't know that, it's something that you need to know. Okay, because when we assess it from that sort of investor lens, we're not just looking at your revenue growth. Okay, will it make good money tomorrow? So can we underwrite the cash flow performance of a business 3 to 5 years in the future? Now, personally, the biggest exit that I've ever been involved in was a 14 times multiple. And the best way to think of that is 14 times or 14 years of profit paid in one day. So why would someone feel that confident that they could underwrite 14 years of profit? Because we'd created predictability, sustainability, repeatability within our business model. So it's not just about making money now, it's about can you prove that the business is going to continue to do that under new ownership. Okay? And then the third piece this is not just about founder dependence, even though I'm going to cover that in a bit of detail today. It's any entity that you have a relationship with. It could be a key customer, it could be a key supplier, right? Anything that there's one point of failure that if that was taken away, the whole business model, the valuation would plummet. That's a huge risk. And when we say preparation takes sometimes years, years of actually getting your business ready to go to market, it's because some of the decisions you make are not quick fixes. And if they are seen as quick fixes, they're going to be pulled apart through due diligence when someone acquires your company. Okay, so simple definition, but I wanted to go through that just in a bit of detail so you can see again how a sophisticated investor like a private equity firm would approach it. So why does this matter? So these are the biggest mistakes that we see founders in particular make, right? So the average founder that we work with, and this is kind of pre and post transaction, usually leaves somewhere between 5 million and 20 million on the table at exit. Now we work with businesses that are profitable. They tend to be sort of in the 7 figures and 8 figures of revenue range. So there's a certain amount of profitability that we are working with. We specialize mainly in 8-figure exits and some low 9-figure exits. So when you start to think about this, this is a large percentage of money that's left on the table. Now, from the outside looking in, it looks like a great business. Everything looks like it works. It might have a strong brand, good reputation, been around for a long time, but a sophisticated buyer is not going to be looking at it in the same way. So the key thing I think out of today is making sure that by the time we finish this, you understand exactly what those gaps are that can produce that sort of 5 million to 20 million gap, and have some strategies that you can enact to actually do something about it. Okay. And the key point here from this slide is really the last sort of piece at the end where it says the businesses that sell for the highest multiples don't get lucky. Okay. They don't get lucky. They get prepared. And that's what we want to focus on today. Preparation, when you're thinking about a high value exit, is the most important thing. Okay, giving yourself that runway to achieve what is going to be, without doubt, probably the biggest liquidity event of your life, unless you sell multiple businesses. Either way, normally it's a one and done thing, a one and done wealth event. So I mentioned beforehand that I've spent a lot of time in the rooms making these deals. And I've written about this in my book quite considerably. I talk about the concept of prize versus prey. Okay. Now, this is sometimes hard to admit because I think back and think I was in these rooms, making some of these decisions and actually using those terms. So I'm not particularly proud of it, but I like to be honest on these type of workshops and presentations. If a business comes into a PE firm and it's not very well structured, it's got dependency issues, it's got problems with its revenue predictability. Imagine it's like a house that's for sale that hasn't had any love and care for ages. The garden might look a bit messy, the walls might need painting, there might be some structural issues that you don't really understand. Well, that house is going to be valued significantly lower than perhaps what it could be. Now, in PE terms, when we see a founder come in with a business like that, we call them the prey. And we call them the prey because we know that we can use various strategies and tactics. Remember, we're doing deals every single day. The founder's normally doing a deal once in a lifetime. We can use that information against them. And as I said from the outset of this today, we are in the buy low to sell high game. Now, it's not just that the business is a prey target, it's also the founder, okay? Because we also can pick whether someone knows how to play the game versus someone who is absolutely going to get taken advantage of because we know exactly the rules of engagement. Okay? Not a great position to be in. That's where the money gets left on the table, but absolutely within your power if you are a founder to change that, because it starts with education and it starts with being in rooms like this today just to understand how this works. Okay? The other side of the table is the prize. And the prize is not just the beautiful house that's been renovated before sale, okay, to use that analogy again. It's the founder who is seen as a formidable opponent. And the best way to describe this is in the arena, which is normally the boardroom of a private equity firm, it feels like you're in some sort of gladiatorial contest. So if you turn up there having, knowing how the game is played, having the right people around you, preparing your business the right way, not only are you going to walk away having, won the game, certainly competed in a position that you're going to be able to kind of feel good in yourself, you're going to be taking significantly more money home with you than you are going to be leaving on the table with the private equity firms. Okay. And that is the key to this. So education first, doing something about that education within your business when there is time to act. And then when you do go to market, don't do what most business owners do, what most founders do. They just go and hire a broker or an investment banker. We work with them. I actually have another business which I'm involved in, which does investment banking and corporate finance. So we're involved in buy and sell side transactions all the time. But the difference with what we do is that we make sure that the business is going to hit the number that that founder, that business owner wants to achieve in advance of going to market. And the problem with a standard broker, just to share this, is quite often they just want to sell the business and they'll be selling multiple businesses. They don't have the ability or the interest to prepare those businesses. And that's the biggest difference I see with founders who don't, understand how this game is played in advance. Okay, so let's keep kicking on. I mentioned beforehand the number of acquisitions and exits that I've been involved in. We tend to specialize in an area which is called the lower mid market, which is transactions that are in that sort of 8-figure to 9-figure range. It's also where the majority of private equity firms exists. So even if you're listening to this and saying, hey, I don't want to sell my company to PE, one thing I'll point out is that 50% of all 8-figure transactions have got private equity money in them today, and it's predicted to be over 70% by 2030. So if your goal listening to this is to sell your business for 8, possibly 9 figures, it is going to have private equity money in it. Doesn't mean it's a PE firm buying your company, but what it does mean is they've probably backed another company that's going to acquire your company, right? So really, really clear point. If you want to achieve an 8 to 9-figure exit, you have to understand private equity, okay? And the psychology as well as the tactics and the strategies, which we'll cover. So this is a summary of kind of what I just went through then in terms of the prize versus the prey. And you might think that sounds really horrific and manipulative. And to some extent it is. But again, as I said, if you just treat it like a game, you just need to understand that, right? But here's the key. You think as a business owner, as a founder, that you've built something really, really valuable, right? You're probably too close to it, right? It's probably your baby, right? This thing you've had for sometimes 10, 20, 30 years, and you think it's amazing. And you look at it through the lens of revenue. I've got customers that have been with me for years. I've got a great team, great track record. That's what you see. And that's, again, that's pretty obvious. And most people think of it like that. I've worked hard to build this thing, right? The problem is that a sophisticated buyer is not looking at it in the same way. They're seeing the same things that you're seeing, but they have a different terminology for them. Okay, so they're looking at you and saying, how reliant is this business on you? You think that's a good thing because, hey, look, look, I've built this amazing thing. I've built this team, whatever. But the more that the business is less reliant on you, the more valuable it is. Okay. Second thing is you might have a few great customers that you play golf with every single week, but they make up a hell of a lot of your total revenue. And if you don't play golf with them every week because you're now, a multimillionaire, what's going to happen? Are they going to stick around while this new PE firm or someone else is owning your company? Maybe, maybe not, right? So the key thing here is all of that is under the guise of risk. And I mentioned the word before, underwriting. We are underwriting risk as a sophisticated buyer. And so every time we see risk, we see the word discount, okay? Which simply means we're going to pay you less than what your business is actually worth because you haven't taken the time to understand that risk or those risks in advance. Okay? Now, most founders don't see this, and it is really the key thing here around what we call the valuation gap. Okay? So I want to show you exactly what that means. Before I do that, can I just check in? How are we all doing? Let's give me a thumbs up. Are we all picking up what I'm putting down? Let's have a look in the chat. We're getting anyone? Is everyone still here, Stephen?
Yeah, we've had some extra people join as well. So let's see if they're still listening in.
Okay, we've got a good. Okay, everyone. Okay, some of the stuff I do cover gets quite technical, so I do want to encourage you again that you can ask questions for context, but then we'll have a good opportunity at the end to cover any more sort of detailed questions. Okay, good. Okay, so moving on. And this is a really simple way to explain what is starting to kind of develop into a more complex scenario. So you may have just a picture in a market, right? Let's say it's in the two education businesses, two identical businesses, right? So they've got similar amounts of revenue, education, as I mentioned for this example, and they've got pretty much the same EBITDA, the same net profit. And then one of those businesses sells, so they both go to market. One of those businesses sells for 4 times their profit. Okay, so obviously valuations are usually, certainly in my world, the profit in the business, normally trailing 12 months, sometimes the last 3 years, but trailing 12 months, whatever that profit is, times by a multiple. The key thing about the multiple is that you can't define what industry range exists within the multiple. So it's called a multiple range. So if I say something like education businesses, the range in education businesses can be anywhere from 4 times to 12 times. Now, how does that work out? So how can a business, in that range, what's the difference? We're going to go through where you sit in that range in a second. But the way that that's worked out is by all the transactions that are happening in the market and also the valuations of public companies in terms of their market capitalization. So you can't influence the range. If you're in an industry, the range exists. What you can, though, influence, which is the key thing, is where you sit in the range. Now, as this example says, well, hold on, they're the same profit. Why is one selling for 4 times and another one is selling for 8 times? Okay, the difference here, as you can see, is a 20 million exit versus a 40 million exit. The difference is in what we call their transfer value. So it's the transferability of the asset from one owner to the next. So even though the businesses can be the same level of profit, one that has that predictability of performance into the future is the thing that dictates the valuation more than anything else. So I labor this point a little bit here because a lot of, again, founders that we work with, they think it's all about just getting to the maximum level of profitability in their business. Sometimes they think it's just revenue, but let's assume that you understand it's about cash flow, so it's about profit. So they spend all this time building up profitability. They take cost out. They get rid of things that have been important in the whole construct of the company. And then when they go and sell it, they're surprised that they get a valuation which is significantly lower than they thought. And it's because they haven't built a transferable asset. Okay, so there's a lot in this, even though it looks relatively simple. But if you're a founder, you need to be thinking about two things. How can I maximize the profitability and the margin of my business to generate cash flow now and into the future? And how can I build the machine so that the asset is transferable to a new ownership? Putting those two things together is what's going to maximize your valuation. And in summary, they're the things that really bridge the gap more than anything else. Okay, so question for you. If you are a founder, and I want you to drop this into the chat, what multiple do you think your business would sell for today? Okay, let's give me an idea. So let's just play around with this. You may not know, that's okay. We do have a free valuation tool if anyone wants to access that and put their numbers into that. So you can actually get an idea, and that takes industry multiple ranges with profit. Okay, so Nick said 3 to 5 times. Okay, good. The rule of thumb is smaller businesses that are subscale tend to sell for smaller multiples. And then I mentioned my 14x exit, which I'll go through a little bit later. They're ones that are really, really well built, scaled, structurally sound. Okay, 6 times, 5 times. Okay, good. No one's got unrealistic like 80 times EBITDA.
I'm surprised there's none of those yet. There must be someone who thinks it's 10x.
Zero income startup. There's still values in startups. We don't tend to specialize in that area, Tarek. but you sometimes you've got to raise against a business that's pre-revenue, which is fine. Okay, well, let's keep going through. So if everyone's cool, I want to talk about private equity in a bit more detail now. So in PE, we have a very, very simple playbook, and I talk about this quite extensively in my book, Exit for Millions. But it's really not about the buying of a business or the selling of a business. It's what happens in between those two activities or those two initiatives. Now, there are 5 levers that every PE firm that I've worked with uses. And some of these you'll look at and go, well, they seem obvious, but there is three here that are not. Okay, so first and foremost, revenue growth. Having a business that is growing and can show growth into the future is super important. If the business is going backwards, if it's had a blip year or something like that, then that will decrease the valuation unless you can justify an extraordinary situation. Okay. But most founders understand growing revenue, sales and marketing predominantly, getting that optimized, basically how you can efficiently bring customers into your business and sell them something. Okay. Margin expansion is also what most founders understand because it's about how do I make my business more profitable? How do I increase the margin, either the gross margin or the net margin? However, it's not just about that, okay? Because the easiest way to do that is to go in there and take cost out. It's not so much about, can I get rid of that person and replace them with AI, even though that is a key thing to look at. It's actually looking at your business model. Is there a different way that I can structure how the business operates to make it more efficient and make it more effective? I worked with a client recently in a training organization where we tripled their revenue in 12 months and we did one thing. And most people think this is crazy. They were selling a 12-month program. We turned it into a 36-month program. Now, we didn't actually sell. So the way to think of this is every person coming in was paying for 12 months up front. When we offered a 3-year program, we didn't just sell it as 3 years. We offered 2 years and you got the third free if you committed for that. So basically you paid for 2 years. So that went like crazy. It sold extremely well. And all we did was just change the way the offer and the product was formulated. So we managed to double the revenue through that mechanism. And then we introduced a services layer where we could kind of upsell and cross-sell against the customer base. And that added another significant amount to the revenue. So all of that, even though it's making the business more valuable, is really about thinking about how you structure it. Okay? So a lot of founders understand the first two, but that's just some examples. The next three are where it gets interesting. So in private equity, we love debt, okay? Particularly when the cost of capital is cheap. So whenever we buy a company, we want to put the majority of the money that we're putting into that asset from debt. Now, most founders really hate the concept of debt, hate the idea of borrowing. And I get it. I mean, you should never borrow money, in my opinion, to fix a problem, but you should borrow money to accelerate growth. Okay. And so there is a very, very big difference. If you want to get yourself in trouble, borrow debt to kind of put out the fires. If you want to kind of create a business that's significantly valuable, borrow money to do strategic growth. So 3 and 4 here actually work together. So what happens in PE is we buy a business that's normally called the platform. Okay. And then from that, we buy other businesses using debt predominantly to create a group structure. And that's often called a roll-up. If you're rolling up a number of businesses within an industry, sometimes it's called buy and build. Okay. But the concept there is that you're using strategic growth through acquisitions and partnerships to compound the value of your organic growth. Okay. Most, again, founders, some understand this now because acquisitions gets a lot of, airplay and talking. So obviously Jeremy and Callum, they talk about this a lot, but lots of business owners to this day that we work with don't really understand how they can use acquisitions to be able to not just grow their business for a liquidity event, but how they can just grow the overall profitability of their business to make more income today. Okay. So the fifth lever is multiple expansion. And this does dovetail a little bit of what I said beforehand about the transferability of a business. But really what we're talking about here is what are the things that we can do as we build this group to make the multiple go higher, right? So I'll give you an example of this. I was the CEO of the international division of a education business. And we were the first acquisition outside of North America. And I was put in to replace the founder and then run that business. Because we bought this beachhead into Europe, right? UK business into Europe, that was seen as value enhancing by the PE firm that eventually bought us. So we think that was worth 1 to 2 points on the multiple just because we could demonstrate that this US-based business could operate internationally. Okay, so some clever things there that are just kind of like strategic things that can flex that multiple. And as I said, if your profits, whatever it is, it's the multiple and how you can, increase the number of points on the multiple that's going to give you the largest proportion of that liquidity upside. Okay, I'm going to pause there quickly because there's a lot I've covered in here. This, if you understand this slide, you effectively understand how private equity works in its most simplest form. And it's not difficult, but it's a little bit maybe of a different way of looking at how businesses grow and scale and become more valuable. So any questions on that? Nothing coming through, Stephen? Thought I'd just quick check in. Looking good?
Nothing yet. Be interested to hear from the attendees if anyone's, bought a business or done any of these activities before. Be quite interesting to hear if anyone's done any of the 5 steps properly.
Anyone coming
Maybe
through?
acquisitions, maybe any
Anyone
roll-up
done any
strategy.
acquisitions? So let's have a look at that. You might have bought a business to become an entrepreneur. So acquisition entrepreneurship, that's cool. Or you've got a business and you're thinking about acquisitions, or you've done a few. Stunned silence.
Silence in the room, yeah.
People understand the importance of this. I think so, hopefully. All right, I'm going to move on. Let's see if anyone comes through. Okay. So this is kind of to reframe effectively what we said. So like if you're a founder, you will see years and years of work. As I mentioned before, you might think your business is your baby. It's certainly a huge part of your identity. You're going to be thinking, revenue growth. Look how I've grown the revenue here. I've got these customers. I've got this team, right? But as I mentioned, risk, dependency, concentration, and a business that they'll discount. That's what the sophisticated buyers are looking at. And what I want to cover now is the 5 most common, I'm going to call them discounts, that we see that affect businesses when they're going to market, and certainly when we assess them before going to market. Now, there are others, but these are the ones that really, really jump out. Okay, so to summarize them, and I'm going to go through them all in a bit of detail in a second, the 5 things that buyers use to justify paying less for your business. So the first one we've covered a little bit today is around that founder or key person dependency. So anytime that there's that reliance, like I mentioned in the high value business definition, on any one individual or entity, it is the biggest discount by far. You can sometimes have a valuation get discounted by 30 to 40% because of this one thing alone. It's also a
Can I
hard thing to
jump in
fix
for a
quickly.
second?
Yeah, jump in.
We've got a raised hand from Anna.
Okay,
So I think she's got a question. Maybe we can let her in.
go for it. I need a drink of water anyway.
Uh, I suppose you hear me. I actually put it in a Q&A, but maybe you have got it late. I wanted an example of capital, structuring the capital, because I'm not sure that I understood. It's a previous slide.
Okay. Yeah, I'm happy to cover how that works as well. So yeah, great question as well. So when you think about capital, you have 2 main forms. I'll go through this in the most simplistic way. I'm sure people understand this. You have equity, right, where people own a stake in the business, and you can sell a stake in the business. It's normally through shares or options, okay, and someone pays you money for that, for a percentage. So you might sell 5%, 10% of your company, and there's cash that you generate from that, okay, or capital. That's one way. Debt is effectively borrowing, it's getting a loan against certain assets and certain factors that the business has. Now, you can just go and get a business loan if you want from a high street bank. Don't advise that. There's usually things called personal guarantees against your house and all that. So that's a loan that you effectively can sometimes make against your situation. But the most effective forms of debt are what we call asset finance. And you can borrow money against most of the assets in a business. So one of the key ones is receivables. So let's say you've got an invoice that's due to be paid, it hasn't been paid. You can actually borrow up to 70% of the value of that invoice. The other one is contract value. So I'm working with a business at the moment that has just won a 3 million USD contract, and they need 500K out of that contract in advance in order to be able to build the infrastructure to deliver that contract. So they're out at the moment seeking contract finance to be able to have a kind of line of credit to be able to build the machine in order to service that account. So there's lots of ways that you can access debt, and there are lots of different independent sort of vehicles. who can help structure that as well. We do a lot of it through our investment bank, Arcan Swiss Capital as well. Final thing I'll say here, though, is how private equity uses it. Okay, so if you think about a deal, let's say a business is worth $10 million. Most people think that when a PE firm buys a business, and they would normally buy a business a bit bigger than that, but we'll just use this for round numbers. Most people think that they come in with their own cash, right? They put their own money in the deal. The reality is, of that 10 million, they're only putting about 2 million of their own money in. Okay, 2 million is coming from their investors. Usually when they buy a business like that, they buy up to sort of 70 to 80% of it, and the rest has to be earned over time. So the gap in the middle is anywhere around that 50% of the valuation. So let's say $5 million of that 10 million valuation is coming from debt. Okay, and they're going out to various debt providers to access that capital. So sometimes that can also be private banks, other institutions, and things like that that provide debt finance. Okay, so that's what I mean by structuring capital. As a small business owner, you can do the same thing, right? There are multiple ways of doing this. And I mentioned the business that needs that contract finance. They're only a small business. They're seven figures of revenue, but only just. But because they've got that contract, they can leverage that as an asset to get debt against it. Okay, hope that helps. But that's what we mean. Different ways. Not enough to cover it all today, but hopefully that gives you an idea. Okay, so back to the 5 things, and I said I'm going to go through these in a bit more detail. So the second one is revenue quality. Not all revenue is created equal. And I'm going to go through a resource that you can use around that in a second. Customer concentration. So do you have over-reliance on 1 or 2 customers generating the majority of your revenue? 4, big one, low profit or minimal growth. So I've talked throughout today about the importance of future cash flow. So if your business isn't profitable or the growth is going backwards, then that's a big issue. You need to fix that before you go to market. And then the 5th one is reporting and transparency. So you've got to be able to show everything that you're trying to justify in terms of the value of your company. So that's the financial reporting, what we often call audit-ready financials. It's any of the key optics and KPIs in your business. So it could be things like lifetime value. It could be churn rates, all sorts of things. Because anyone who comes in to buy your company is going to do a process called due diligence, which is anywhere between 60 to 90 days for an 8 to 9 figure company. And they are going to be going through every line of your business, every component, every structure, every process in order to see if it's worth the money that you're saying it's worth. Okay, so that's why these are key things. Okay, I'm going to go through each of these in a bit of detail. So gap 1, we said there is this idea of founder dependence. We see this in about 80% of the businesses that we work with, and we see it as the primary valuation gap. So as I'm going through this slide, I want you to think about this. If you took 90 days off from your business starting on Monday, would the business be better, the same, or worse when you got back? So I want you to put into the chat, if the business would be better, put a 1. If the business would be the same, put a 2. If the business would be worse when you came back, put a 3. Okay, so for anyone here who's a business owner, okay, good, we've got the same. Anyone think it's going to be better? Sometimes it happens, particularly if you're intentional about it. Okay, worse. Okay, a lot of the same. Okay. You want to get to a point where actually it improves, believe it or not. You want to get to a point where you can go away because that 90 days can sometimes turn into multiple months. And there's a point where you actually exit the operation of your business and it runs without you fully. That's the key. Okay, good. Thank you for sharing that, guys. So how do you fix that? Right? So how do you fix this? Well, the first thing is you've got to have, a decent management layer. You've got to have leaders and managers in your business. Depending on the size of your business, you have different tiering. So you have like a C-suite if you're a bigger business, which is where all the kind of main strategic leadership sits. Then you'll have a management layer, and then you'll have an execution layer. It just depends on the size, but you've got to have depth. Okay. In PE, we used to talk about going across and through an organization to make sure that the key areas driving the strategy had key points of accountability. Okay. You've got to have documented processes. Okay, they're systems, SOPs, making sure that everyone knows what they're accountable for and doing. And these days, you've really got to have a really strong strategy around how AI and technology is making your processes more efficient. Okay. And then the last one is delegated authority, which is making sure that whoever you have in your senior team, they own the outcomes. They own the decisions. So if they have to come to you all the time to sign off an employee contract or an invoice or whatever else, then, you don't have a business that runs without you. You have a business that's dependent on you. Okay. So I'm going to fly through this conscious of time, but that's the first one. Second one is revenue. Now, not all revenue is created equal, and there is a podcast episode I did a few weeks back which goes into depth on this, and we're going to link that, I think, to the chat. And the key thing here is that most people think that when you're growing revenue, there isn't much of a kind of like a mix of what you're doing, but there are three main ways of looking at revenue. The most premium way, the one that drives your multiple up on a valuation, is anything that is recurring or contracted, simply because it's predictable into the future. Okay. Second tier is anything that's repeat. In other words, it happens on a predictable basis, but it's not contracted. In situations like that, it's considered pretty good, but it's still risky. The worst is project-based, one-off or lumpy revenue. And if your whole, let's say 80% of your revenue is lumpy or project-based, you're going to get discounted in valuation. So if you're looking at this today, you should be thinking, well, how can I contract what can be contracted? How can I create any sort of recurring revenue model? And how can I, reduce anything that is, again, dependent on me, relationships-wise? Make sure that when you assess all the revenue coming into your business, that you're looking at what is called the quality of the earnings. And the reason that's an important thing to understand is that a PE firm, very much a sophisticated PE firm, is going to run a quality of earnings analysis through the due diligence process. And if the quality of the revenue generation isn't strong, they're going to discount massively. This is the second biggest discount that we see other than founder dependency. Okay, third, and I touched on this earlier, your biggest client might be your biggest liability. So a couple of statistics here. If you have no individual client or customer making up any more than 20% of your revenue, that's fine. Okay, so because 80% of the revenue is coming from other customers, right? Now, of course, it depends on the business and depends on the industry and everything like that, but you don't want to have huge dependency. If you've got any single customer, being between 20 and 50% of your revenue, that's starting to become an issue. If you have any that are above 50%, so one massive customer and then like 10 small ones, but that one customer, unless it's contracted for the next decade, you are going to get discounted through valuation. So how do you fix this? Well, first and foremost, you diversify your customer base. You make sure that you've got the right mix of volume of customers or clients and also value. But you make sure that there's no single relationship that dictates the overall performance or value of business. Now, if you buy a company and that's already in there, you've got to work like hard to diversify the whole revenue base over a period of time. It's not going to be something you can do straight away in order to make sure that you mitigate that risk. Because if I buy the business and, all of a sudden that customer leaves, what happens? The valuation is half or more. Okay. Now, we talked beforehand about growth, but this is the cash flow story. And there are three key things here. So firstly, we need to know how much profit the business is making, right? So we're buying future earnings. We're buying the cash flow into the future. So we need to understand how well the business generates EBITDA or net profit. Okay, so again, ideally from audited accounts. We need to show that the evidence of growth is both trailing and going forward. So when we sold a business called Ascend Learning, we had 10 years of revenue growth that we could predictably show. So it wasn't crazy to think that we could predictably push that into the future either. Okay. And then the last one is margin story. So we go into detail in PE looking at both product and customer profitability. And we want to show that the optics in the business are actually driving growth, not just the top line numbers. Okay, so there's quite a lot in this, but the key thing here is you've got to say, okay, well, if I'm going to buy my own business, how confident am I that this business is going to keep performing as it has over the last few years into the next few years? And if you can't answer that question because you're not looking at the data enough or the KPIs or anything like that, you need to fix that in advance. And you want to be able to show that predictability into the future. Okay, and the fifth one, the fifth gap is really just the reporting. So if you can't show what you're saying and presenting to justify the value of your business, I can't buy it. I can't pay you for it, right? I need to know revenue by customer, pipeline visibility, quality of earnings, which I mentioned beforehand. And the more simply that I can understand the way that you are running this business from a kind of reporting infrastructure, then the more I'm going to pay for it, right? Because I can just take that over and I can understand it simply. The more that it's in a desk drawer, in your head, in your CFO's head, whatever, then obviously that's an issue. It needs to all be out. Now, we've covered quite a few of these things today, so I'm not going to spend too long on it. But the key thing here is that these gaps are all, pretty significant. So as you're looking at them, is there one of them that hit the hardest? So again, in the chat, put a 1, 2, 3, 4, or 5. Which of the 5 that I went through today has hit the hardest? Maybe it's one that you need to really start to think about once this session finishes. Okay. How are we time-wise? We're into Q&A.
Yeah, it's all good though. Yeah, it'd be
Fine.
interesting to hear because I think, typically the ones we look at, and we mentioned that earlier, Nick, is number one, isn't it? Founder dependency tends to be the biggest
Yeah,
one.
it's the biggest one. And revenue quality, I think, is probably that as well. But they're all important. So the key thing here is to say that it's not just about one, it's about how these gaps can compound. So we said beforehand, the most important thing to take away from today is preparation. So each of those things, if you look at it, is not something you fix within 5 minutes, right? It's something that you have to kind of think about into the future. And quite often, exit preparation can be a 12 to 36-month process. But as we mentioned, that's the difference between somewhere between 5 and 20 million that you're taking home that the private equity firm or the sophisticated buyer isn't. So here's how that looks, right? So we often see that if you've got one gap, that's kind of manageable. 2 is a pattern. If you've got 3 of the 5, that's starting to become a major issue. And on average, we see around 2 to 3 out of the 5 every time we start working with a founder-led business. Okay. And the key thing we want to do is obviously bridge that gap to get that 20 million swing or whatever it looks like on your side of the table versus theirs. It's the main reason why we exist as a firm. Now, what I'm going to do here quickly is just drop in another podcast into the chat. So we covered 5 key gaps today. There are 15 that are really, really quite technical. The podcast that I have dropped into the chat is my #1 most listened to podcast episode of all time. It's in, I think, 4 business schools as required listening in the M&A classes in North America. And it's a very, very, I think, quite simple 25, 30 minutes just to understand this in more depth. Okay, the key things we covered are there, the 5, but there is more that you definitely need to educate yourself on here. Okay, so in terms of what we do, just to share that with you, we work with founders and investors at every stage, from growth and scale all up to raising investment to acquiring companies and exiting. And we start with businesses that are quite early stage who need mentoring and coaching to scale all the way through to actually running the processes of an actual sale liquidity event. So just to share with you what we have. So we do have a valuation assessment. I mentioned that beforehand. You can get an access to that. I think we dropped it into the chat beforehand and get your business valued for free. So you can get an understanding of where you are today. We also do mentorship for CEOs and for founders who are really at the earlier stages navigating growth and scale and thinking, okay, how do I build the right infrastructure to be able to make my business more valuable? We have an audit that we do with businesses that are really getting intentional about the gap. So the idea that, hey, my business is worth X today, I want it to be worth Y tomorrow. What do I need to do? And that's a pretty intense 3 to 4 week process where we do effectively a due diligence analysis on your business to give you absolute precision on what you need to fix. If there are gaps, which there often are, we then can come in and fix those gaps strategically and also operationally. So we bring an operating partner into your business like a PE firm would, and we also bring in specialists across various areas. So it could be marketing, it could be finance, it could be operations, even going into businesses now and starting to look at where AI can make them more profitable and valuable. So that's part of how we execute that. And then the last thing is once a business is ready to go to market, we can actually sell those businesses, run the full process through Arcan Swiss Capital. So it's a full end-to-end delivery, if you like. And sometimes people do the audit and they're ready to go to market straight away. sometimes, as I said, there are gaps which we've covered, and we have to spend more time with those businesses, getting them ready to make sure that they can achieve that outcome. Just to reiterate again, if anything has resonated with you today, there's a link to book a call with the team. So if you want to talk about any of the stuff, particularly pertinent to your business, then please click that link and book a call. In terms of the process, I'm going to fly through these last few slides. We have three main ways that we work. We assess, which is identifying the gaps we mentioned beforehand. We build the plan and execute the plan with you. And then depending on what your outcome is, we help you achieve that outcome. So sometimes it is just purely growth and scale. Sometimes it's raising that investment. Sometimes it is acquiring companies to bolt onto your existing company. And of course, it's about achieving that high value exit, that life-changing liquidity event. And this is an example of how that works in theory. This is a business where I was brought in to be the sort of interim CEO. It's an education business in the UK that was worth around £30 million. I came in with the team. We had to do a whole heap of restructuring in this business. We had to stabilize the financial performance. We had to change the business model. But the problem was we had to do that quickly because the private equity firm that owned the parent company in the US wanted to sell that group. And this is the example I mentioned before of the UK bolt-on that was super important to increase the multiple. So we were involved in this business for around about 18, 24 months in total. We grew revenue by 28% in that time by changing the go-to-market strategy. And we ended up participating in a 14x multiple. It was actually a business valued at over 2 billion USD in the end, and we were part of that. The whole time from when we came in to do the fixing to the exit was 36 months. So these things can be done quickly if you operate with the right capability and the right precision. And the PE sponsor who was the owner of the group said, without the UK turnaround, without the work that we did there, the group valuation doesn't get where it needs to be. So we made quite a significant difference, even though we weren't a huge part of that group. So I share that just simply to show you that, when you get focused, you can make things happen quickly, and you've got to have the right people around you to make that happen too. Okay, so in terms of just who we work with, just to kind of give you a bit of sense of that. So founders, if you're listening to this today and you're a founder building towards a meaningful exit, you might think right now my business isn't worth what it needs it to be, or you may just not simply know. But you do want to maximize that exit value, and you want to do the work to address the gaps, and you understand the concept of preparation, then that's who we like to work with. On the investor side, where there are family offices, search funds, smaller private equity firms, where there's this making a controlled or majority investment in the business, we like to go in and kick the tires on those businesses, provide an independent assessment, and actually, if there is work to be done post-acquisition to scale those companies, then we can bring the operating support and team to do so. Now, I know a few people here listening today sit on the boards of some of these companies. You might sit on the board of a family office, or you might be sitting on the board of a founder-led company and you're advising in. If any of those are building to an exit and you're looking at this thinking, actually, I could advise them that they should be preparing in advance, then you can reach out to us and we can partner with you on that as well. Okay, so again, book a call if that's of interest. Okay, so that is it. I mentioned about booking a call. We've got the link in there, haven't we, Stephen?
Yes, we've had a couple of people already sign up,
brilliant.
which is good. We'll speak to them soon.
Okay, excellent. So yeah, so as I said, if anything's, as I said from the outset, we're not here trying to sell you anything. There's no course or program. It literally is a conversation around what you're trying to build and maybe, what's needed to bridge those gaps. So if that's of interest, click the link and book a call. And I'm a bit over time, but I think we've done all right. So that's it, everybody. We're now at Q&A. I mentioned at the very beginning that if you stay till the end, there would be something for you. And that something for you is a free copy of my book, Exit for Millions. There should be a link there for that. It's a digital PDF copy. It goes through a lot of what we covered today, but in substantially more detail. And it took me 2 years to write the bloody thing. It wasn't AI written. It was a labor of love. But yeah, get a copy of that. And as I mentioned before, I've got the podcast as well, where there's lots of really great episodes and resources. The other thing is, while you're thinking about a question to ask, connect with me on LinkedIn. I spend most of my time going backwards and forwards with people on LinkedIn. There's also a newsletter that I write every week, which is called the PE Operator Playbook. And you can sign up to that newsletter from the featured section in my LinkedIn profile as well. Alrighty, do we have any questions? Maybe this is just so easy, everyone gets it, Stephen.
I'm sure there's some people thinking of the question. Be good to hear. Anyone
What's
with a
that?
hand up?
Well, we can kick around a couple quickly. We've got a few minutes until we finish up today. What do you think some of the biggest questions are that we get when we're speaking to founders or investors?
I think for the ones that we speak to, it's a lack of understanding sometimes that preparation is the key thing. Time passes anyway, and it's important that if you have a business, it's important to build that optionality, whether you choose to sell it or not, because it could be the biggest wealth creation asset you have. Whether you're just starting out, whether you've got an established business, it's important to prepare that. So most people we speak to, it's the first time they're doing it. Maybe they've been burned in the past. I think that's one thing we've noticed, Nick. We do have people that come to us that have worked with other advisors or brokers, as you mentioned before.
Yep.
And it's not been an enjoyable experience. So I think doing that preparation work is so important.
Yep, I agree. I think that's the key thing. And the other thing is, the gap is a real gap, right? And it's a significant number. And sometimes, we'll work with a founder and what they want their business to be worth and what it actually is worth today is right on the money, right? And situations like that, we say, listen, let's go to market. We do a bit of preparation work for that business, but there's not any real value build work. Other times you've got someone who thinks their business is worth 50 million and it's worth maybe 20 million or 30 million, and they're shocked by the difference. And so it just depends. I think we've got a couple of questions coming in, or certainly one I can see.
Yeah, we've got a question from Anna. So the valuation, the best place to start with that, Anna, is the valuation link that we've put in the comments. So that will give you a defensible valuation of your business based on multiple points that have been gathered over many years across real businesses that have sold. So that's the first place to start. And it looks like you've got a food supplements business. Is that correct? Is that your business, Anna?
Yeah, we've got another one coming through, I think, here. Okay, that's fine. Yeah, I mean, I think Stephen's right. Have a look at the valuation tool that we have, and that will give you at least a starting point for where you're at currently. So do we work, there's another one here, it's coming. Do you work with impact investors who have social good as a major objective, and how does that affect valuation models? Yeah, I mean, this is a really good question, actually, because I've probably painted a picture of PE firms being horrific with my prize versus prey piece. But there are lots and lots of family offices in particular that are now thinking more about social, economic, environmental, sustainability impact type of work. And so what happens there though is that people are still putting money in to create something of good, but there is still, the want or the need to have a return on that investment. It's just that it's less punchy, meaning that, instead of going out there and having to get the maximum multiple return, there's a bit of an understanding that as long as we get some return, and sometimes it's over a longer period as well, like less intense, that it's a more, if you're the right founder wanting to kind of go into that world, it can be a better experience. So yeah, so we do work with more, let's call them socially conscious investors as well. Cool. Okay, and we're close to time. I'm happy to go over a couple of minutes if we have got any final questions. But let me just ask everybody, how's everyone found it today? Give me a thumbs up if you've got some value out of what we went through today. If there's some stuff that maybe you hadn't heard before that you've heard for the first time. Oh, great. I can see a clap and a few thumbs coming up. Brilliant. Okay, that was the main purpose today. Fantastic.
Remember, guys, there's a link to book a call with the team if you want to discuss your business and some of the different options that Nick went through earlier. We work with businesses all different shapes and sizes depending on what they need. And we've got a real fantastic team behind us as well.
Very good. All right. Well, thank you, everybody. I think we'll call that a wrap. As Stephen said, sometimes people don't want to share questions in this sort of format. They want to talk about it more privately. So, as I said, book a call for that. But yeah, thanks for your time today. I am really pleased. I can see through the comments here that people are really starting to understand and get more educated on this space, how you achieve these kind of high value exits. So, really pleased to be here. And as I said, reach out to me on LinkedIn, connect with me on LinkedIn, or obviously book a call and speak with the team. All right, everybody. Thank you. Have a good rest of your day. Anything to add, Stephen?
All good. Thanks for joining, everyone.
All right. Thank you very much. Bye bye.